This week is going to be very interesting in the stock market as we have the major companies reporting, especially on Wednesday. We have Microsoft, Meta, and Tesla. So in this video, let's analyze all the most important companies that are reporting this week. And let's start with UNH, which is reporting on Tuesday. Now, UNH is a company that is down 34% in the past year. It took a massive drop from an all-time high of almost $600 per share and fell all the way down to $237. I actually made a video when the stock was trading at $250 per share saying I was buying the stock because I thought it was incredibly cheap, as at that time it was trading at a P of 10. Since then, I am up almost 40%. Now today the stock is trading at a P of 18, the market cap is $317 billion, and analysts still have them rated as a buy with 13% upside. And they also pay a dividend that has a yield of 2.5%, and like we've already seen, the current PE is 18, although we'll talk later more in depth about the valuation with a discounted cash flow model. Now let's take a look at their financials. As you can see, this company has seen amazing revenue growth in the past 10 years, growing from $157 billion to $435 currently. And the same goes with their profit. Net income from $5 billion to 17, although it decreased in 2023, which is one of the reasons why the stock dropped. And now if we take a look at free cash flow, again, the same story. From $8 billion to $17 billion currently. And because this company is in the healthcare sector, their margins are not really good. As you can see, profit margin is around 4%, although they used to do 6%, and free cash flow margin the same, basically 4%, and they also used to do even 7 or 8%. And if we take a look at what analysts are expecting, they are expecting growth both in revenue and profit. Revenue from $459 billion in 2026 to $587 in 2030, so mid-single digit revenue growth, and profit is expected to grow faster from $70.92 per share to $42.82 per share, so double-digit growth for profit. Now let's take a look at some important statistics such as the balance sheet. They have $30 billion in cash and $80 billion in debt, which is manageable for a company that we have seen has a market cap of $316 billion. Now as far as valuation, they are currently trading at a PE and price to free cash flow of 18. But in order to take a deeper look at the valuation, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $212 per share, middle $474, and high $687. And because the stock is currently trading at around $350, this means that if my low assumptions occur, you would get a 7.9% annual return on your money, middle 15.8%, and high 23.1%. So I would say the company is still quite undervalued according to my assumptions, and I think they are reasonable as they have the company growing revenue between 4 and 8%, which is what analysts are expecting, averaging a profit margin and free cash flow margin between 4 and 6%. So again, what they have been doing, and I assigned the PM price to free cash flow at the end of the 7 years of 16, 18, and 20. By the way, these returns include the dividend. Why? Because dividends come from free cash flow, so you cannot double count them. And you can also see how undervalued the company was when the stock was trading at around $250 per share, as according to my low assumptions, you would get market-beating returns. And the stock is down this much for multiple reasons that I also explained in that video, such as the assassination of the CEO, disastrous Q1 earnings, the DOJ criminal fraud investigation, and leadership shakeup. But I thought all those problems were short-term news, which is why I decided to invest in the company. Now, I will say that I've sold the majority of my position in order to buy other companies that I thought were cheaper, and also because I got 40% gains in a month, which is really good. And if the stock falls back to $250 on earnings, I might consider buying more. Now let's take a look at the next company, which is UPS. UPS is another company that has been struggling, down 33% in the past 5 years, although it has rebounded nicely from the lows of $82 per share, now at $107 per share. The current market cap is $90 billion and they are generating $89 billion in revenue, so the price to sales is basically 1. Analysts have them rated as a buy and they are trading at a 4P of 15. Now a lot of people are interested in UPS because of the dividend, as the yield is 6%, but we'll talk more about that later. Now, if we take a look at their financials, they have been struggling lately. Revenue was growing very nicely from 2015 to 2022, but since then, revenue has been dropping and it is now at $89 billion. If we take a look at their profit, kind of similar story. It was at $4.8 billion 10 years ago, and it is now at $5 billion. And I think we cannot take these 3 years into account when valuing the company because they were clearly a fluke year. As we take a look at the free cash flow, kind of the similar story, although more consistent, and it is now at $4.4 billion. Their margins very similar to UNH actually, as profit margin is around 6%, and free cash flow margin a bit lower, around 5 or 6%. Analysts are expecting very little growth, both in revenue and profit. I mean, revenue is expected to actually decrease this year, but then grow to $101 billion, so low single-digit growth, and profit from $7.19 per share to $9.89 per share. Now let's take a look at some important statistics. The company has a little bit of debt as well, as they have $6 billion in cash and $29 billion in debt. And now taking a look at the valuation, the current PE is 16 and the price to free cash flow a bit higher at 20 because they have less free cash flow. And as I've said before, the price to sales is 1. Now, if we take a look at the discounted cash flow model, I have intrinsic value between 59 and 135. So it does look like it's trading around fair value or even a bit expensive, as it would only be a buy according to my high assumptions. But by the way, if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And one thing that I wanted to mention about their dividend is the payout ratio. As you can see, the payout ratio is 101%. This is what percentage of their net income is used to pay the dividend. And if they do not improve their net income, this dividend might get cut in the future. I know net income is expected to improve in the future, but nevertheless, if you invest in this company just for this dividend, you need to take this into account. Finally, my thoughts on UPS is that it's not trading at a sufficient discount. Even if the stock falls back to $82 per share, I think it still needs to fall below that. Now let's take a look at Wednesday because there are a lot of companies reporting. And let's start with ASML, which is reporting earnings before the bell, a very popular stock because it has skyrocketed in the past year, up 93%. The market cap is now $535 billion, and this is a very good company in the semiconductor space, which is very crowded. Now, as you can see, the reason because this stock has jumped is because they saw 22% revenue growth in the past year, so they've been absolutely crushing it. If we take a look at their profit, net income has grown by 33% this year. A slight negative is that free cash flow is a bit lower, currently at $8.9 billion. Now they have amazing margins, gross margin at 52%, profit margin nearly at 30%, and free cash flow margin at 27%. So this company's fundamentals are amazing. And if we take a look at the financial forecast, the revenue growth expected is insane. Double-digit revenue growth percentage and high double-digit profit growth for the next 5 years. The question is, are analysts correct and is this sustainable? Another important statistic is that they have a great balance sheet, as they have $6 billion in cash and $3 billion in debt. By the way, they also pay a dividend, although it is much lower and the yield is currently 0.4%. And overall, although ASML I believe is a fantastic company, I believe much of the gains are done. Now the company is trading at a 4P of 44, which looks a bit expensive. And also, I believe the semiconductor space is very difficult to value at the moment because there is so much competition and hype around it. The next company reporting is Starbucks, another company that is down in the past 5 years, currently 6%. And this company, as you can see in the chart, has been very volatile. I mean, an all-time high of 125, then to $75 per share, then again to 115, then to 75 again. So a lot of volatility in Starbucks. Analysts have them rated as a buy with a price target of 99, and they also pay a dividend which has a yield of 2.5%. If we take a look at their financials, Starbucks was growing revenue very nicely at around double-digit percentage, obviously with the exception of COVID, which we cannot take into account because locations were closed. However, in the last couple of years, they have been struggling and revenue has decreased to single-digit percentage. Now, if we take a look at their profit, they have also been struggling. Net income has fallen from an all-time high of $4.2 billion to $1.8 billion. A good aspect is that they have more free cash flow, currently at $2.4 billion. Obviously, their margins have also fallen. This company used to do between 10 and 15% margins, and now they are doing at around 5 or 6%. Analysts are expecting a slight turnaround, revenue growth, mid-single digits, so not the double-digit percentage they were doing before, and reaching $46 billion in 2029. They are expecting more profit growth from $2.40 per share to $3.94 per share. Now, if we take a look at their balance sheet, you're going to see that Starbucks has some debt, as they have $3.4 billion in cash and $26 billion in debt. However, I wouldn't be worried about this amount of debt because a lot of it are leases. Now, my problem with Starbucks is the current valuation. As you can see, I have intrinsic value between 26 and 76, and the stock is currently trading at around $97 per share. So I think Starbucks needs to fall a bit more in order for me to consider it, although it's in a tough position at the moment. By the way, if you want access to where I've shown all the stock data, which if you are an investor, you know that data is everything, you can get access to stockanalysis.com and you can use my discount code VALUE at checkout to get 10% off. Now let's move on to Wednesday after the market closes, which is where a lot of things are going to happen because as you can see, Microsoft, Meta, and Tesla are reporting. Let's start with Microsoft, which now has a market cap of $3.5 trillion, and they are generating $293 billion in revenue. Analysts have them rated as a strong buy with a price target of 31% upside, and the company is up 106% in the past 5 years. Now, Microsoft is just a beast of a company. Their revenue hasn't stopped growing from $91 billion to $293 billion currently. They are currently growing at high double-digit revenue growth, which is insane for how large the company is. Their net income has also grown from $20 billion to $104 currently. A slight negative is that free cash flow is considerably less, currently at $78 billion. Obviously, because this is a software company, their margins are insane: 68% gross margin, 35% profit margin, and 26% free cash flow margin. If we take a look at what analysts are expecting, they are still expecting this company to keep growing at high double digit. I mean, everything is just insane about Microsoft, and reach $573 billion in 2030. Profit as well expected to grow at high double digit. Now, the only issue I have with Microsoft is the current valuation. As you can see, I have intrinsic value between 266 and 694, and the stock is currently trading at around 474. So I would say it's trading around fair value, not expensive, but also not cheap. And I just think there are better opportunities in the market currently. Now let's take a look at Meta stock. A stock that in the past 5 years, if we take a look at the chart, at one point was around $88 per share. Now, when it was trading at around $150 per share, I actually made a video saying I was buying the stock. So this stock, as you can see, has done tremendous for me. Actually, someone commented saying, I hope you dumped your life savings into it. I didn't do that, obviously, but I made a lot of money with returns of over 500%, and I recently sold a lot of it. Now, if we take a look at the financials, Meta is a beast of a company, again from $17 billion to $189, and they are growing at around 20% annually in the past couple of years. Now, if we take a look at their profit, net income again has seen tremendous growth from $3.7 billion to $58 billion. Now, when the stock was around $100 per share, the story was they were spending a lot of money on the metaverse. And my view at that time was that, first of all, this was a clear overreaction by the market and the stock was trading insanely cheap. And second of all, if they just stopped spending that money in the metaverse, if it didn't work out, all of that money will just add to the bottom line, which is what happened. Now, this company in the advertisement market has amazing margins: 82% gross margin, 30% profit margin, and again, a slight negative is less free cash flow. And if we take a look at revenue by geography, where I see a huge opportunity for Meta is in the rest of the world. As you can see, in the past couple of years, they have been growing this segment around 90% last year, and the year before at 74%, which is insane. And as these parts of the world become more and more developed, the average revenue per user in these areas will get higher, which will drive a lot of profit for Meta. If we take a look at what the returns we will get on the stock if we invest in it today at around $672 per share, according to my lowest options, you would get a 1% annual return on your money, middle 10.5%, and high 18.4%. So I would say Meta is interesting again. However, I do have a bias as I've owned the company in the past and made tremendous money. And I can see why a lot of people are getting interested in Meta again. However, I just believe there are better opportunities in the market. The next company we have is Tesla, another one of the Magnificent Seven, which is up 49% in the past 5 years. The current market cap is $1.4 trillion and they made $45 billion in revenue. This is a price to sales of around 15. And just for reference, car companies usually trade at a price to sales of under 1. And the current PE ratio is 302. So off the bat, the stock looks very expensive, but let's see if fundamentals justify this high valuation. Now, revenue has seen tremendous growth from 2015 to 2023. However, as you can see in the past couple of years, they have been struggling regarding revenue. And if we take a look at their profit, they reached an all-time high of $15 billion, but since then, it has decreased all the way to $5 billion. And free cash flow is a bit higher, so a slight positive, and it is currently at $7 billion. Now, I know people say Tesla is a software company, and they do have a software aspect to it, but it's very little. And as you can see, their margins, we have seen other software companies have more than 30% margins. Tesla's profit margin is currently at 5%, and free cash flow margin is currently at 7%. Although it is true that during a year, they were doing around 15% margins. But even though they have been struggling, analysts are expecting tons of growth both in revenue and profit. Revenue from $108 billion this year to $259, which is insane. And more impressively, profit from $2.13 per share to $11.56 per share in 2030. So first of all, we need to ask ourselves the following questions. Is this realistic? And second of all, even if this happens, can we still pay a good price today, or is Tesla still overvalued despite these expectations? Now, according to my spreadsheet, it is overvalued. As you can see, heavily. According to my low assumptions, intrinsic value is 31, middle 81, and high 319. Now, on my high assumptions, I assume Tesla is an absolute 100% software company, as I have Tesla with 13% revenue growth and 30% margins. Keep in mind they are currently doing 5%. So I know a lot of people are attached to this stock, but I think this is a stock that is going to struggle a lot in the future because valuations matter, and when you pay too much for a stock, your returns will suffer. I want to make a quick note on overall market valuations. If we take a look at the Schiller PE ratio, we are currently at 40. Now, this is almost the same level we saw during the dot-com bubble, which reached 44. Now, when this happens, market returns are very bad. Why? This is logical in investing. The more you pay for something, the less your returns are going to be. The less you pay or the cheaper you get stocks, the higher your returns. So we have to be very careful, and especially on earnings season, I think the market could fall. Now let's move on to Thursday, where we also have some very important companies. Now, I recently covered MasterCard and Visa in other videos in case you want to check it out. So let's take a look at Apple, which reports after the close. Now, Apple, another of the Magnificent Seven, current market cap $3.7 trillion. Analysts have them rated as a buy with 15% upside. Now, if we take a look at their financials, Apple was growing revenue very nicely until 2022. And then they were struggling for a couple of years, but it seems like they've picked up growth again, as last year they grew revenue by 6%. And as you can see, the year before 2% and the year before negative 2%. If we take a look at their profit, it has also picked up and they are currently at an all-time high. And Apple is a company that has been improving its margins. As you can see, gross margin is currently at 46%, profit margin at 26%, and free cash flow margin a bit lower at 23%. Apple is a beast of a company, and analysts are expecting them to go back to that growth they used to have in the past. As you can see, from $461 billion to $589, and profit from $8.42 per share to $30.91 per share. And I also agree with analyst outlook. I believe Apple is going to get back to growth. However, I just believe the valuation is a bit stretched at the moment. As you can see, the stock is currently trading at $255 per share, and I have intrinsic value of 137 to 249. This goes in line with my overall view that the market is currently overvalued. Now, this doesn't mean you shouldn't buy any stocks. If you take a look at my channel, I have stocks currently in my portfolio. It's just that it's harder to find value, and I prefer to hold more cash in case the market crashes. And finally, let's move on to Friday, where I'm going to cover SOFI and American Express because these are companies that have done tremendous for me in the past 2 years. I was recommended buying SOFI at around $7 per share, and as you can see, the stock is currently at around 25. I've obviously sold the majority of my position because gains were over 300% at one point. Now, if we take a look at their financials, the reason I was interested in SOFI was number one, because this company is growing like crazy, from $506 million to $3.2 billion. And last year, they grew revenue at around 30%. Now, because this is a bank, when we look at the profit, we have to completely ignore free cash flow, which as you can see is currently negative $3 billion. The reason is because banks report things differently, so we have to focus more on net income. And this used to be an unprofitable company, and they are now generating $640 million in net income. If we take a look at their statistics, they also have an amazing balance sheet with $3 billion in cash and $2.8 billion in debt. And as you can see, at the time, I was very interested in SOFI because of the valuation. I saw a small company with a lot of growth potential and that was trading cheap. At the time, it was trading around $7 per share, and it had intrinsic value between 4 and 27. Now, at current prices, obviously, I don't know if I'm interested. I think the valuation has gotten a bit expensive, which is why I'm going to pass on this company for now. But it has done tremendous for me, so I am very grateful for it. And in terms of American Express, it was a bit of a different story. Contrary to SOFI, American Express is a well-established company, so this was just the case when I bought the stock around $150 per share that I just thought the stock was clearly undervalued and it was a very solid company. As you can see, when I ran the DCF model, the stock was around 150 and I had intrinsic value between 253 according to free cash flow and $400 per share. But again, like SOFI, because I already own the stock, I'm a bit biased and I'm not currently interested in the stock. I hope you found this video valuable. Let me know what stocks you want to buy during earnings and I'll see you in the next one.